Good morning and welcome to our fourth quarter webinar. Today we're going to be sharing what are some of our best ideas, what's in our portfolios, and essentially what's our outlook as Old Mutual Investment Group. I'm very excited that today I'm joined by our Chief Investment Officer, Siboniso Nxumalo, our Head of Equities Research, Meryl, and our Investment Analyst, Irina, Schulenburg. And really excited just to have a really engaged discussion. So I hope you'll get your questions ready and send them to us. You've got a chat box there. So please, as you're listening, pop in some questions. We'll have some time at the end to broach those questions with our panelists today. So before we jump into the stock analysis and what's in our portfolios, I think it's always helpful to have a general overview of the macroeconomic environment. So I'm going to start with Sibu. And really, you can't be speaking macroeconomics right now and not be talking about Trump. So I think a lot of people had deja vu a few weeks ago, where now we have a new president-elect, Mr. Donald Trump, and he's got policies around America first, make America great again. All sorts of policies that have obviously implications for all of us. So what does this outcome then mean for markets in the medium to long term? And in particular, with the strengthened dollar that we saw after the announcement, what does that mean for emerging markets? And I think while I'm still asking you that, I think it's also interesting to note that, in September, there was a stimulus in China. What impact has that had? Has it revived that economy, and is it enough?
Thank you, Mpho. And good morning to the audience. I mean, before we jump into America, I think let's remind the audience what we've spoken about this year in terms of our positioning. And one of the things we started talking about earlier on this year was about how there were global headwinds and local tailwinds. So in the global economy, we saw headwinds. We saw some question marks about the U.S. economy and U.S. markets, given where it was and how expensive it is. We saw some local opportunities in South Africa. And so therefore, today, we're just going to continue down that same path, except we're going to get into the stock specific. But let's start with about America. We've got a chart here which actually is going to frame the Trump 2.0. 2016 was Trump 1.0. Basically, I think the market has greeted Trump's elections with a lot of enthusiasm. We've seen the market go up. We've seen Bitcoin go up. We've seen the tech shares go up. And so therefore, there's a lot of excitement about his policies. I suppose the question we've got to ask, because in the investment world, the news is one thing, but you've actually got to delve deeper and look at some facts and look at some analysis behind it. And when we compare Trump 2016 to 2024, we look at this and we say, his job is going to be substantially more difficult in 2024 because of where the market and the economy is. So again, if you look at 2016, the real GDP growth was 1.6. Relative to now, GDP growth is 2.8, and it's starting to recover in America. If you look at unemployment, in 2016 was 4.7, but now it's even lower. So where's the room? This is considered full employment now. And so therefore, how do you improve from there? If you look at inflation, 2016 was 1.7. Now, inflation in the US has been higher, especially this year it's coming down, but actually you can see it's at 3%. So there are questions about inflation. Should Trump then wish to obviously stimulate as per his policies? What's even more challenging is the next number, the federal funds rate or the interest rate in America. In 2016, interest rate was 0.41. Now it's closer to 5. And so, yes, that can be hard, but there's pressure in the system. But what's even more important, I suppose, he's come into a market that's a lot more positive and optimistic than it was in 2016. And you can see that by the expectations in the market as implied by the S&P 500. So 2016, he came in at a PE ratio of 22.8 for the S&P 500. Now it's over 30 times. The margins are very high. It's concentrated in a tech sector that is very narrow. The last time the market was this concentrated was in the 70s. And that didn't work out well going forward. So Trump is coming in, lots of positive rhetoric, but actually, he's got challenges, structural challenges. And one of the things there we've got at the end is a corporate tax rate. One of the things he did do when he came in was cut the corporate tax rate. And we can see the corporate tax rate from 35, now it's 21. There's an argument that actually all of those tax rates that he cut is going to reverse back to the 35s. But actually, the question that is being asked now, how much further can it go lower? Because the government deficits that they're running are unsustainable. So we're saying, hey, Trump is wonderful, I suppose, in the short term. The market had a sugar rush, but actually you've got to look deeper and say his job is going to be very difficult going forward.
And then perhaps then shifting over to China?
Yeah. So yes, one of the things we spoke about, China has three primary issues. It's got an issue of debt. It's got high debt levels. It's got an issue of demographics. It's that it's got an aging population, and its population will now start shrinking going forward. And it's got deflation. And deflation is a symptom of the first two things that I met. And you can see here in this specific chart that actually, that from an inflation perspective, you've got deflation, and deflation is a sign of a weakening economy that has no demand. And in that particular, if you think about wages, we live in South Africa, and so we live in that premise that there's inflation, and then we get some form of increase, and we can increase our spending power, and we can spend. But in a world of deflation, actually, there is no spending power increase. In fact, how then do you boost consumer spending? What are you buying with? Because deflation means that your income is getting lower. The trick about it, though, is that your debt stays the same. And so, therefore, you start entering the squeeze. Now, when you look at China, we've seen this in Japan. Japan endured decades of deflation, and that wasn't good for the economy. And we see, I think in the next slide, the Chinese, I suppose, realized this, and they tried to stimulate the economy earlier on this year. And you can see that little rise. This is the Chinese MSCI Chinese PE ratio. But the market, there was euphoria. We saw resources go up in South Africa. We saw Richemont and Naspers, which we're going to talk about a little bit later, go up. But the problem was the market looked at this and said, it's not enough. It's not big enough a stimulus. And so therefore, it's challenged. So China now has to come back. And they tried to come back again, and the market's still not buying it. It's saying, you need more to save this market. And your market has actually got structural issues. And so as an investment firm, we've got to then look at this and say, well, given that China influences probably half our economy, how do we invest in that market? Because we've got resources that obviously China is the biggest consumer of resources, and then we've got the biggest company, Naspers process, which is driven by Tencent, which we're going to talk about, and then we've also got Richemont, which is also driven by China. We're going to talk about those. And so, therefore, when we looked at China, we're saying, well, there's a lot to worry about in China. The market valuation is telling you that. The unsuccessful stimulus is telling you that. And so, therefore, how do you invest in that particular world? And we're going to touch on that.
Thanks, Ewan. In fact, I think it's a great time to bring Irina in. Let's actually touch on Richemont, and especially with Chinese consumer spending, like you say. I mean, I remember when I was studying in China in 2018, I was hearing about entire buildings that are sitting empty. So that Chinese property crisis itself is something that's very prominent right now. Could you give us some thoughts around Chinese properties, consumers, and then also leading onto Richemont?
Thank you very much for that, Mpho. Very exciting to be chatting about Richemont. I think that it's also quite topical. Post-COVID, we saw quite a strong rally in all the luxury shares, and that was fueled by consumers having quite a lot of high savings, and then some of what people refer to as the revenge spending. So it boosted the shares quite nicely. And then as the consumer came under pressure as a result of the inflation and rising interest rates globally, as well as the more specific conditions emerging in China, we've seen challenges in the sector year to date. And actually, there's quite a big polarization in the industry as a whole. We've seen some shares almost halving year to date, and others like Richemont and Hermès that are up mid-single digit in euros year to date. So I think that it obviously begs the question as to why do we like Richemont and why do we hold it on behalf of clients? It is a cyclical company, but with a twist. And as our viewers will see, we've got a chart there of BHP, Billiton, and Richemont, both plotted in euros. And this is a log scale just to account for the 30-year chart. And I think you can see it is a cyclical company, but with a twist in that it has pricing power. So therefore, it allows you to price for one of the most destructive forces in markets, which is inflation. So what do we like about Richemont as a company? So firstly, it is in an industry that has pricing power. One positive. The second positive is that the majority of its portfolio is exposed to the branded luxury goods sector, and that sector is taking share from the unbranded sector. So you have firstly, exposure to a strong growth sector, but also one where the share of branded versus unbranded in jewelry in particular versus other luxury categories is still very low. It is in its infancy. So the pathway for growth is still quite strong. The third point is a strong balance sheet. So not only are they in a very strong net cash position, but they have fairly low levels of long-term debt, which has actually got a very long duration. So if we look at the liquid resources, so kind of cash at your disposal, it is currently sitting at 12 billion euros. That doesn't sound like a lot, but when you actually put it in rands, it's 230 billion rand that they have in cash. So what does that do for our clients? It does two things for you. Firstly, it provides a lot of protection in case a black swan event emerges, therefore making the business a lot more resilient. And the second thing is that it clearly gives you a lot more optionality, so that you can take advantage of opportunities if and when they present themselves. And I think the third thing is this management team has done a lot of very positive changes, but they've all happened quite slowly and incrementally. So they have improved their control over their cost base. They have improved the vertical integration of the business. They have improved the way they reach their clients, so the distribution channel. They are a lot more retail, meaning closer to the consumer as opposed to wholesale as part of their history. These have all culminated to produce a more resilient business. And kind of what is one anecdote, because people always say like, show me. What is one anecdote to do that? So if we look at the group's geographic exposure to mainland China, Hong Kong and Macau as one, it was sitting just a notch below 30% a year ago. Those sales are down 27% year on year. I mean, it's quite a number for almost a third of your business to be down so much. And yet, in the first half, the group results were flat on a revenue basis. So it shows that the business is more resilient. The management team has diversified the exposure across other markets. So when one tends to dip down, another one is able to offset it. And I guess you're going to say, Irina, I need more proof, aren't you, Mpho?
Of course.
I think another way to show our viewers this is that this is the group operating margin that you can see in front of you. And over this long period of time, you can see two things, that the lows are getting higher and the highs are getting higher. So what does that tell us? That structurally, the business is becoming stronger and better well run. And I think the last thing that we can say about Richemont is historically there were a number of question marks over management succession in the business and quite a lot of lack of clarity on reporting lines, as well as the composition of the board of directors. We are very happy to see the recent management appointments that are firstly very strong, and we look forward to evaluating their success on behalf of clients. I hope that answers your question.
No,
Thank you.
Absolutely. Thank you, Irina. And I guess, Sibu, going back to what you already mentioned also about process and Tencent, could you put us in your confidence about some of your views around how processes perform?
Yeah, so if we follow on Irina, I mean, I think, like I said initially, China's got some structural issues they've got to deal with. And one of those structural issues actually is that China, in terms of fixed investment or gross capital fixed formation, so how they've driven the economy between 1980 and up until now has actually largely been fixed investment. So actual spending on building buildings and infrastructure, et cetera, and their fixed capital investment relative to GDP is double what every other developed country is. But at some point, you've built enough buildings, you've built enough roads, and you've built enough infrastructure. And what we're seeing now is that their economy has got to go through a natural transition. This happened in the US in the 1960s, where they switched from a manufacturing made in China into a consumer-led economy. And so what we are saying in China is that now this is why we are favoring, I suppose, the more consumer-related names in China, like Richemont and Tencent, which I'm going to speak about now, rather than the traditional Chinese exposure of commodities companies. So now if we come to Tencent, which is one of the largest companies in China, and what we like about it is if you look at this particular chart, I mean, we are investors and we like valuations that are attractive. This is the price earnings multiple of Tencent, and you can see that relative to its history, it is looking very low. Now, whenever this happens, something is given in the market that says actually the market's got doubt, it's got pessimism into it. And we look at this particular company, at the bottom there, I've attached the growth profile. You can see in 2024, which is likely backed in, you've got 37% growth, 11% and close to 12% growth. And so a low multiple with a decent amount of growth for a very large company that actually has got some semblance of economic strength and pricing power, because half of Tencent is gaming, and then we've got marketing, and then we've got payments. And so that's generally the makeup of the company. Now, what we like about it is that actually gaming is a fairly addictive product. I mean, I've got little kids and they like gaming, and so therefore that's actually a good marketing. Marketing and advertising in China is at its infancy, and so in China, if you compare it to the rest of the world, because it's been a fixed investment economy, actually the idea of advertising and advertising penetration is rather low in China. So that's going to grow with time as they become more and more consumer orientated, and obviously fintech and payment, that then also will do the same thing. And so for us, we like this company. This is our biggest holding on behalf of clients. One, because it's got growth. Two, it's obviously trading at valuations that are attractive, and we can buy it in terms of, and we buy it obviously through Naspers and process. The other thing that we've seen in this company, it's now become a very large company. So it's no longer a very high growth company. And yet management then is acting like it's a high growth company, like it's not a high growth company, because we've seen management buying back its own shares, actually divesting of investments that it has. So it's simplifying the business. It's doing the right things in terms of capital allocation. And yet, also, when you come to South Africa, the company we buy this, which is Process and Naspers, they're also doing something similar. In that Naspers and Process, they've basically, out of their exco of about 12 people, they've changed 7 of them. And all of a sudden, the last result that we saw, the last trading statement, talked about this e-commerce business. Actually, they're starting to come to make profits. And so, therefore, we are starting to see capital discipline in this particular company too. So, from us, as an investors, we're saying, okay, Tencent's capital discipline is making us happy. Naspers Process capital discipline is making us happy. The valuation is attractive, and the discount between the two actually is also at a good space. So that's why this is then the biggest holding we have. And yet, if we compare, remember earlier on I talked about the US and the US tech. If we compare Tencent versus the US tech names of Meta, which owns Facebook and Instagram and all WhatsApp, Alphabet, which owns Google, etc. If we compare what we call the PEG ratio. Now, in 2020, you can see those squiggly lines there that distort the picture a little bit. But when we look at this particular chart, it's an interesting chart because it tells us that relative to the growth prospects, we are paying possibly close to the lowest multiples for Tencent relative to US tech. And so, yes, Chinese tech has got some regulatory issues, but it actually looks like those have calmed down. It's a strong business, but the price we're paying for this access to this assets that is still growing and dominant, actually for us is very attractive, especially relative to the assets you can buy globally. And like I said, we've got issues about the US, we've got question marks about the valuations of the US and the sustainability of that. But when we look at this particular company, we're saying, hey, there's an opportunity here at a good price for a strong business where Naspers Process, the capital discipline is good, and then obviously offshore we are looking and saying Tencent itself, its capital discipline is good. And so actually this is why we own Naspers Process.
Awesome. I'd like to bring Meryl in now, actually. Today is quite an exciting day. The SARB will be announcing their decision. There's been a lot of talk about a possible 25 bips rate cut. So really, and I mean, when we look at some of the stocks that we're going to unpack later on today, it's really stocks that are sensitive to interest rates. So this is important. So what is the outlook on SA Inc.? Do we also think it's going to be around this 25 basis points cut? Do we agree with those forecasts?
Yeah, Mpho, I think the 25 basis points has been kind of well telegraphed and anticipated. I think anything more than that would be a surprise. So far, the SARB has demonstrated a tendency to lean more hawkish and be cautious and pace themselves with the Fed in the US, so that wouldn't be surprising. We talked for about a year now about headwinds, but also tailwinds emerging for SA Inc. and for SA Consumer in particular, and the growth rate, the inflation rate, etc., has been such in South Africa low enough to accommodate a rate cut. And I think waiting for the Fed was the thing. Now we are starting to see that unfold, which is obviously great for consumer. But I just want to rewind a bit. If we just zoom out and think where we were, you can pick a time. I feel like South Africans have very short memory, and we get focused on what's going wrong now. If you rewind 2 years ago, we were doing calls with some of the private equity guys in the group to say, your holding companies, how are they preparing for stage 8 load shedding? You know, Twitter was trending with Ashcom, etc. Our holding companies as well. The conversations around around stage 6, around Transnet falling apart, and it just seemed like every piece of negative news that could come our way was coming our way in terms of the South African economy. And obviously, if you rewind even further than that, we've had the downgrade to junk, we've had the Nene Gate era, we've had all of that turmoil in the last 10 years. And I think when we looked at this early 2023, it was clear that this is most likely the point of maximum pessimism. And much of this was priced in at that point in time. And the question is, can it then get worse? And are you paying for that downside risk, or is it all priced in? And we took the view that actually much of this is priced, and we started accumulating some of the economically sensitive stocks, which Irina is going to talk about, in particular the retailers, between March 23 and July 23, because the macro picture had been so bad for so long, number one, but also cyclically, at some point, we were anticipating that rate cut. The surprise for this year has been the two-pot system as well, which potentially is a shot in the arm to consumer. But against that backdrop, perhaps somewhat contrarian position that we took more than a year ago to start getting into the cyclicals. And yeah, we can chat about banks and then retailers.
Yeah, so in terms of the cyclicals, I mean, yesterday's CPI print was, over the last 50 years, if you look at the inflation prints over the last 50 years, this one is the third lowest. It's only been lower in 2020. We know what happened in 2020, and in 2004. And so, therefore, there is room for the SARB to be more aggressive in terms of rate cuts. Now, like Meryl said, they have acted very cautiously. But nonetheless, we can see that the trend towards cutting interest rates and boosting, obviously, consumer spending, that is good. So therefore, when we talk about the cyclically sensitive stocks, so first one we're going to talk about is banks. So we've got the big 4 banks there. And I've got 2 lines in these particular banks. I've got the return on equity, which is a measure of the profitability of the banks. But on the bottom there, I've got the price to book ratio, which is a valuation measure of the banks. And you can see I've got an average line for return on equity, and that actually it's been there before between 2018 all the way to like 2010, 2011. And so the return on equity has recovered. So the profitability of the banks has recovered in South Africa, but the valuation has not recovered. And I think the next slide obviously points this out. It's why we hold such a high position in the banks, and that in banks, you value banks relative to the government bond. And given the nature of their business. And if you look at this relative to the government bond, if you take the SA banks in average and you put them relative, you can see it looks fairish. It's on the average line. So then why are banks trading at such a discount? They're trading at a discount because if you look at the bond, the government bond below, after 2021, it started going upwards. It was pricing sovereign risk into South Africa. Because of our finances, we've got very high debt levels, and our growth is not high enough to obviously offset that. And then we had load shedding, and then we had all sorts of politics and people asking questions. And all of a sudden this year, you have seen the bond rate come down. Now you're starting to see, I think, one of the rating agencies upgrade our outlook to positive. And with the government, obviously, and the GNU coming together, and again, you've seen that. And so therefore, we've seen banks, I think on average this year, they've gone up about 22% or so. Different ones going up at different multiples. So So our thesis is actually then also starting to play out, even in the banking space. And so for us, in terms of why we hold the banks in particular, is because we think that there's too much of the sovereign risk of South Africa priced in, and actually they also are all usually beneficiaries of lower interest rates. People can consume more, and we're seeing them now starting to lend. If you look at the data, they're starting to lend a little bit more because the consumer then, as interest rates go down, will become under even less pressure.
Great. In fact, still keeping in this theme of the decreasing interest rates, we know the clothing retailers tend to outperform in that sort of environment where there are rate cuts. Irina, I'm curious to know your views also, your outlook on that industry.
Yeah, I think you're quite right in that they are interest rate sensitive, that they do respond to lower inflation and a stronger rand environment. And so if we look back at 2023, almost like the perfect negative storm of all those happened. You had inflation, which was rising and quite high. You had interest rates, which were rising and quite high. And you had a currency, which was weakening considerably against hard currencies. And so as a result, the shares came down considerably. You can see in the blue line, the relative to performance to the JSE, the shares had underperformed meaningfully. And at that point in time, we felt that they were discounting quite a negative economic outlook for a very long period of time and extrapolating some very temporary and company-specific issues over a long period of time. So we felt that it gave us enough of a margin of safety from a valuation standpoint to invest in the shares. And then we thought that there would be some optionality if some of these headwinds were transitory as we expected and or the macroeconomic environment improved. I think just to set the scene in 2023, the shares had come into a very challenging environment. We had almost a 10-year period where we had very limited growth in household disposable income. Interest rates were rising. Inflation was rising. They had increased competition. And there were a number of other challenges like load shedding as well as domestic as well as international logistical issues. That led to a 10-year compounded annual growth rate in earnings of between 0 and 5%. I mean, that's barely keeping up with inflation. And as our viewers would know, share prices follow earnings, and as a result, the share prices were quite depressed at that point in time. So kind of given that I've given you that background, why is it the time to engage the sector? I think for first point is that the margin of safety. So the valuations to us were deemed quite attractive and therefore gave us the margin of safety. And what are these short and medium term optionalities that we saw? I think the first one is inventory. The balance sheets of the retailers were relatively weaker in 2023 versus previous years because they had bought in quite a lot of inventory, and at the same time you faced a very weak consumer as well as load shedding. Okay, that meant that you had to discount the stock quite aggressively in order to convert it back into cash. So we knew that that would be very negative from a reported earnings perspective, but very positive in that it strengthened the balance sheet. So remember, we focus a lot on balance sheet because cash is a bit like oxygen to a business. You never really think about it until you don't have it. And then that's all you think about. So we were happy that the balance sheets were looking stronger. The next is load shedding. Firstly, the retailers themselves added backup power in the stores, and the rest of SA Inc. also added alternative energy sources with a culmination of other things leading to a reduction in the events of load shedding. That meant that consumers were a lot more confident and ultimately came back to the shops because no one really feels like shopping in a dark mall with very poor lighting. And I think the third thing was the little kind of company-specific issues that happened. As you would know, when it rains, it pours, a bit of that analogy. So I'm going to call out two companies, the Foschini Group. they were consolidating a number of their warehouses into one central facility. As you can imagine, this process of, Lego pieces and rejigging them around leads to a lot of duplication of costs. At the same time, their competitor, Mr. Price, was doing two things. They were integrating an acquisition of Studio 88, and they were implementing a new ERP system which had a number of glitches. The ERP system is your IT system that governs your day-to-day operations of the business. So I think if you put it all together, what is retail about? Retail is about having the right product in front of the right customer at the right time. If you have logistical issues and system issues that are preventing you from that, that creates both additional costs and lost sales. Both of these issues we felt were transitory, and the companies would lap that. At the same time, I think that having faced a very challenging environment for the last 10 years, these companies weren't standing still. They were doing a lot more to make their businesses more resilient. How? By diversifying their customers, by diversifying their revenue sources, by diversifying their logistics chains, being able to supply stocks domestically or internationally, etc. So we thought, if the environment just turns even a little bit, obviously we had no line of sight on the very favorable and positive outcome of the elections, but we thought if there was that optionality, well, A, we weren't paying for it, and B, the businesses are more resilient and therefore better positioned to take advantage. Now, as we have seen, some of that, luckily, or like it always needs to be on your side, has come into fruition, and we've already seen Mr. Price today coming out with their interim numbers and guiding numbers for October and November being up very comfortably double digits. So I think so far what we have seen from the shares is that we have seen an improvement in the share prices, kind of being driven by the PE re-rating. Now the earnings need to come through, and we will obviously evaluate these opportunities on behalf of our clients and try to make the most of it. Thank you for the question.
Awesome. And Meryl, so I mean, we've seen traditionally, especially in developed economies, when there's an interest rate cut, it's a positive indicator for gold. So, I mean, we've seen already gold has had quite a bull run for quite some time. So what is your outlook on gold at this point in time?
My favorite question, because I feel like the short answer is who knows. But yeah, gold is a puzzle you can spend your life trying to solve. And just when you figure out what the driver is or has been for the past 10 years, it changes. But we try our best to understand gold through this framework. And maybe I'll start in the red block. When do you absolutely kind of not want to be in gold? I like to call that block the Goldilocks era. I think we were there in the 90s. Strong growth, strong dollar, low and stable inflation, and high rates, because then you have an alternative yield. Avoid gold. And I think we ran out of axes, but geopolitical stability and relative peace times also needs to somehow feature into that. And I think it feels these days we tick fewer and fewer of those boxes. Growth, yes, there are pockets of the world that are firing, there are pockets that are not. Yeah. Inflation, it's stabilizing, but at a higher rate than I think what we've seen for 40 years in developed markets. With that, yes, does come higher rates, but they are coming down at this point, which is favorable for gold. The dollar has been very strong, but it's been very strong for long. If we look on a more structural view, we are starting to see at the margins this multipolarity theme emerging, particularly the BRICS nations together with OPEC looking at ways to trade commodities outside of the dollar framework, which longer term asks questions about the ongoing strength of the dollar. On inflation, we talked about Trump earlier. He's got somewhat populist policies that are being talked about. In the long term, many of those will be inflationary. So if you take immigration, for example, to clamp down on that, well, what does that then do for the available labor pool and wage growth, for example? The America first or Germany first or whoever first is inflationary because manufacturing things at scale in China, whether we like it or not, was good for consumers around the world in terms of the price we pay for things. So we are unwinding all of those trends. So structurally, we still see many bullish trends for gold. Now, has it already run too hard? That's the question. This was a much easier question to answer 2 years ago. Gold troughed at $16.34 an ounce in September 2022. 2 years hence, we are 63% up at whatever it is today, 2,670 or so. So can that keep going? That sounds like a very big move. However, in gold terms, I actually don't see that as a very big move. If you look at all the price moves since the dollar was unpegged from gold in the 1970s, this as a move barely clips the top half in terms of the size of an ongoing rally. So we've seen more sustained and in totality bigger moves trough to peak than this, even in the 2000s. So it is strong, but we cannot confidently say that it's over. That's how I would phrase it. So when you don't know, what do? You look at scenarios. And I think what I've done here is just aggregate the big three South African gold miners, which is how we access gold on behalf of clients, mainly Harmony Gold, Gold Fields, and Anglo Gold. I think, first of all, South African gold mine is a bit of a misnomer these days. The one that really is truly South African these days is Harmony Gold. So exposure to South Africa and its mining climate and policy risk in the gold mining sector has far reduced versus 10 years ago. Gold Fields and Anglo Gold are quite geographically diversified these days. But if you aggregate those in the different scenarios, on each of these charts have got different pricing scenarios. So should gold fall to 1,700 per ounce, 2,000 per ounce, where it is now is about 2,600, or should it go to 3,200 per ounce? And why that number? Well, I've looked at every big move in the gold price since the 1970s, and actually from that 1634 in 2022 to the average move over that period, it actually gets you to 3,200, which sounds like an astronomical number, but it's not impossible, actually. So that is a scenario we consider. And I think compared to the last time we saw the gold price really crash, around 2012, it fell from 1,900 down to 1,100. Balance sheets were very geared. These companies were not generating the free cash flow margins that they should have. What tended to happen was, as the gold price went up, they mined ever more marginal ounces, and so you never really got the cash flow or the profits dropping through to the bottom line. In that vulnerable position, management experienced a gold price crash, and then there was this era of austerity and conservative capital allocation. And the evidence of that is still in the numbers, because if we just look at, let's say, the middle chart, even at 1,700 gold price, the cash positions of these companies is still okay. The debt is not excessive. This is a chart of net debt to EBITDA. Where we are now, if these gold prices sustain for the next 2 years, calendar year 25 and 26, at 2,600, the sector will be actually pretty cash flush. and there are question marks as to what they do with that. We've started to see some acquisitional activity. But both free cash flow margins all the way down to 1,700, they're not into cash burning territory as a sector, and the balance sheets are still reasonable. If we stay where we are or go higher, which is the more bullish scenario, it's even more attractive. And I think the chart on the right is the interesting part for me, because that tells me on a valuation basis, the market ain't buying it. Typically through the cycle, gold miners trade at between 1.5–2% dividend yield. That looks closer to the $2,000 mark at a sector level as to what are the gold shares telling me the gold price that the market expects. So if fair is 1.5–2%, it would say they're reflecting a price of 2,000. They're not pricing in that this 2,600 can sustain and continue. And based on the work that we've done, geopolitical risk, structural inflation drivers, structural question marks on global growth going forward, and let us not even get into the amount of liquidity that has been pumped into the system since COVID, the levels of debt on various government balance sheets. We actually do not think that it's a ridiculous thought that gold can sustain at these levels for another 18 to 24 months.
And I think while you're still holding the mic, I'd love for you to touch on the Old Mutual Gold Fund. And, what are some of the strategic changes that you've implemented in the fund, given the current market conditions? We've seen the fund has performed relatively well this year.
Yes, it's on a one-year view, it's up north of 40%. I mean, obviously in a year where gold itself has remained strong, and some of the counters, for example, Harmony Gold on a one-year view is up 70%. So that leverage to the gold price is coming through. My strategy for the gold fund has been reasonably consistent over time, which is, number one, what is the view on the gold price? If I'm bullish on the gold price and the Rand gold price, I want to be exposed to equities because I think the operating leverage should come through. At the times that the fund has held the commodity itself, it's when we've been more bearish on. So that 2012-2013 period that I referred to before, we had up to 15% in the actual ETF because the view was the shares from here are going to underperform. So that strategy has remained consistent, and then certainly diversifying among the majors is important. They each have different drivers of growth. They've each had a CEO change. The most latest has been Harmony Gold announcing Bayers. So it is interesting to observe how this new generation of CEOs that didn't live through the austerity era are going to handle being so cash flush. Can the capital allocation discipline be maintained? That is what I'm pushing each management team on when we meet with them. That is what I'm looking for as a shareholder, that the promises that were made, that when the glory days come for the commodity, we as shareholders are going to participate in that return. And I think, so the acquisition activity, I will be monitoring tightly. So far, Harmony Gold has been the one that is going for greenfields opportunities and being the most prudent with their capital allocation.
Thanks, Saul. I think we've got some good time to delve into some questions from the audience. So I'm going to look at the first question that we have up on the screen. What is the catalyst to drive valuation uplift? How does that reconcile to the view on China over the medium term? I'm going to throw it to you, Sibu.
Yeah, so I can take that one. So, I suppose with China, I think they've shown you the catalyst. China is the second largest economy in the world, and I think in 2027 they will overtake the US as a large. So this is a material economy. So they obviously looked at deflation. And if you study Japan, because one of the ways to understand where China is going is you've got to look at South Korea and you've got to look at Japan, because they are ahead of the development of China. They've got the same structural problems that emerged there. So Japan spent a couple of decades in deflation. Deflation, like I said, is not good. It's not good for any economy because you don't get inflationary pressures. And even for markets rely, like Irina was saying, on earnings or profitability growing. But in a world of deflation, in China, you are selling, if you just think of revenue of a company, you are selling its price and volume. So the volumes in China are decreasing because you've got a declining population, you've got less buyers, and then now you don't even have inflation, you don't have pricing power. That's why we like Richemont, because it has pricing power. And so therefore, they've got to do something. And they came out with some form of stimulus, but this stimulus was different from what they used to do historically, because historically China used to stimulate via property investment. But they've said, hey, that's not going to work anymore because we've got too much data, we've got too much infrastructure. And so now this particular stimulus that we saw this time was largely consumer focused and consumer based, in trying to put money in the pockets of consumers to go out there and shop and spend, because that's the objective that they've got to get done. And all that happened, the stimulus was there, but the market said it's not large enough to take us out of the deflation spiral. And so therefore, what's then going to happen is we've seen a little bit of a stimulus also announced this week. And again, that also didn't do much for the markets. So they're telling you that they're going to catalyze it by saying we're going to keep coming back until something happens. And so they've painted, I think, the picture in terms of what will catalyze, I suppose, value creation in China.
Awesome. Let's see. What's our second question? Is it fair to compare valuation multiples for Tencent relative to US tech peers, considering that US companies are competitive on a global scale and Tencent is predominantly exposed to China? What is an acceptable discount if the current discount is too wide?
You know what's fascinating about this question is it has an assumption. It's that the Chinese companies are exposed to China. If you look at Apple's exposure, I think about 40% or so of Apple is in China. And so therefore, and if you look at Apple's performance over the last, probably 5, 6, 7 years, a large part of Apple's rise is the re-rating. The PE has risen much faster than the earnings have risen. Why? Because it sold more phones and things in China. And so therefore, how come Apple gets a look and we say, hey, Apple's exposed to China, it can sustain its multiples? The second one that I'm going to mention in terms of tech is NVIDIA. So NVIDIA is the hottest thing in the market now. And NVIDIA actually, where does it get its chips from? It gets them from Taiwan, a company called Taiwan Semiconductors. And so, again, you look at that and say, well, actually, there's this thing about whether China considers Taiwan as one of their provinces. And so, therefore, there is this whole talk of does China then take over? So therefore, I think we've got to step back from those assumptions and test them with some facts. And when we look at Tencent, when I suppose Tencent was a growth company and the Chinese tech companies were growth companies, they were valued. And if you look at them between 2020 all the way back to 2010, they largely traded at similar multiples to the US ones. Obviously, now the US has become hotter, its economy is growing much faster, and the earnings of those companies have grown much faster. And so therefore, that's the difference. But also China has been discounted because every now and then the government wants to go and regulate the industry. So there is that bit of a discount. But we've seen quietening down on that front. We've seen the Chinese government saying we want to stimulate. And each time that comes out, we do see the same names going up. And so for us, we would cause questions on the US tech names because the multiples are very high. The margins are very high. And actually now there's also then talk about them being deregulated and them obviously being broken up. There's a big case now about Alphabet, which owns Google, being broken up because they own, obviously, the Android system, they own YouTube, and they own search, and they dominate those categories. So actually, is that right? And if you look at history in the US, every now and then the US regulators do come in and actually force companies to break up, to break the dominance and the monopolistic tendencies. And so for us, given the multiples in the US, they are expecting a continuation of positive conditions. And I think relative to where these tech names are trading, we would cast doubt on that. In the Chinese ones, they're expecting a continuation of bad news to continue. we don't think that that is sustainable because we can see it in the earnings coming through. And so therefore, that's why we would prefer Tencent.
But also, can I add to that? The assumption is that Tencent is only exposed to China, which isn't 100% true. Within the gaming division, they have many holdings in companies that have exposure to international gaming. So really, they have a finger in almost any popular game, wherever the studio is, even if it's an American studio. So that's the one thing. And I think the regulation is a gift and a curse because it has given them a protected environment. Google, you can't, if you go to China, you can't get onto Google. So they have this very big and very walled off market. I think AI has been very topical for the US tech shares, but I think in the last 10 years, Chinese companies have issued more patents in something related to AI than the US. They're just not grabbing the headlines because they're not chat GPT type things. They're in the business to business or productivity related space.
And we also have a question. In fact, Meryl, this is likely for you. Can you perhaps comment on gold shares versus gold coins? Some clients are disinvesting to buy coins, also silver.
Yeah, I mean, I suppose it would be similar to my decision of the gold ETF, New Gold, versus the shares themselves. I think the shares come with higher potential return and also higher potential risk for disappointment because they are run by human beings. There are companies that are run by human beings. So from here, the price that I put up as a potential bull case for gold, let's say 3,200. From here, 2,600 to 3,200. I think I worked it out yesterday, it's maybe another 20% up. So if you buy that physical coin today, if you're a South African and you're buying a Kruger today, then you also have to think about the rand. Is the rand going strengthening or not from here? So what is the rand gold price doing? Let's assume the rand stays where it is. Then you're getting about a 20% move on the metal itself. I think if that scenario plays out, the shares run much harder than that because that, through operating leverage, falls through to the bottom line. However, if you look, depending on the time frame you look at, you have to acknowledge that management teams are certainly skilled at squandering some of that cash flow away, which is why I typically don't like to hold one, because there can be an operational mishap. So in a general equity fund, I prefer not to hold one. There can be operational mishaps, weak M&A, et cetera, et cetera. But from post that last crash where they all got burnt in 2013, the South African miners have actually exceeded the gold ETF in terms of returns from 2013 to now. You can zoom into specific one-year periods where that hasn't been the case, but that capital discipline is there on that 10-year view. The question is it going to remain? I think that era is still close enough in the rearview mirror for that to still be in the boardroom dynamic, that we need to think about hurdle rates, we need to think about returns. But I think where we are in the gold cycle now, this is the risky time where management teams start making very high hubris acquisitions, and then you don't get the full leverage. But I think from where gold is now, if we get a further run, I would rather be in the shares.
So we've gotten some really great questions. Thank you so much to our audience. Unfortunately, we're running out of time, and I think I'd like to just give a minute each to my panelists, just to tell us what are you most looking out for in 2025. So I think I'll start with you, Irina.
I think the main thing is the consumer and how the consumer finances repair, and how the consumer confidence repairs, because your ability to spend is also a function of confidence, and almost like rate cuts also tend to be a lagging driver to the way that you feel. First rate cuts come through and you're like, oh, okay, a little bit less money, but, I'm still okay, I'm still spending. And then suddenly the pendulum, as with most human beings, it swings from one end to the other. I think it's just looking at how quickly that pendulum is going to swing back. And then also very critically to see how people that are withdrawing savings from the two-pot, how those will be utilized. I understand that in some cases, having had a very torrid period of activity, you maybe just want to go out and splurge and just feel good for a bit. That is one option. The other one would be to pay down debt, another option. So I think it would just be evaluating how that two-pot is being shared and then looking to see how we can capitalize on that on behalf of our clients. Thank you.
Sue?
My one is to go back to the US, given its size and its valuations. And I mean, if you go back to 2009, March 2009, which was the low after the financial crisis, I think then you were buying the S&P 500 at a PE of like between 9 and 11, somewhere there was very low PE relative to the 30 times now. And if you look back then, there was maximum pessimism in America because the banks were failing, the insurance companies were failing, everything was having to be bailed out. And so there was maximum pessimism. All the companies that then subsequently have driven the market, a lot of those actually were new startups, and they were moonshots, as they would be labeled. So they didn't quite exist in the same power that they do today. Today, though, the S&P is at 30 times. It's concentrated in merely 7 companies, and to us, the optimism that behind that is very high. And for us, expectations drive returns. The expectations are very high in the US. And so for us, it's that idea of you've got to be very cautious when expectations are that high. So far, this has hurt our performance because we've been underweight the US. So it hasn't been a great call on our behalf, and we've got to own that. But when it comes to investing, being early is indistinguishable from being wrong. And so we sense that actually we think that we're early, and if the US comes off a little bit, given the starting valuation, the optimism, that will be good for our clients.
Meryl?
Well, I think it's an interesting time to be alive. Because if I refer to that Goldilocks period, we don't have any of those things. We have a war still ongoing in Russia and Ukraine. We have all these weekend wars that seem to last for 3 years. We have Hamas and Israel conflict still ongoing. There are so many industries that are being disrupted, whether it's by AI, whether it's electric vehicles, there's pressure for green transition. There is so much change. I feel like there's so much that in 20 years' time we're going to be looking back at what history was writing about this time. And then as South Africans, we have that also unfolding. We've had a big change after 30 years of a certain political regime. So, and if I look at how some South African companies and management teams have navigated the past 10 years, and now we're starting to see some green shoots. We've also seen really possibly some companies not survive, but the ones that have survived, I am so curious to see what is going to emerge, what has been forged in the fire of the past 10 decades. And some of those companies are in our portfolios for clients.
No, I'm quite excited for 2025. Thank you all. I hope you've also found this as insightful and really interesting as I have. Thank you very much. This is our last webinar for the year, so I am going to take this opportunity to wish you a very happy, safe, restful holiday season, and we will catch you in a very exciting 2025. Thank you.
Thank you.